So I'd like to return to one of the larger conversations that's happening in this class, and that is how we get stability and order and structure in an anarchic system. And I think that sort of general question, when we look at the global economy, leads us into this idea of hegemonic stability. So the hegemonic stability thesis is this sort of idea that was developed by historians and economists and political scientists about what it takes to develop a global economy. And the recognition that a global economy is really a fairly new development, and it's not something that happens automatically, and it's not something that is necessarily guaranteed. And so when we look at the global economic history, we see that there was this period of sort of globalization happening in the 1800s and on into the 1900s. And then at the start of the 20th century, it kind of came crashing down with World War I. And then was revived after World War II. And so the argument is that in order to have a global economy, you need economic infrastructure, right? And someone has to carry the weight and share the or shoulder the costs and make everybody sort of participate in this global system if it's going to actually work. And so that means you need some mechanism to promote open markets. You need something like the GATT or World Trade Organization system, somebody who's putting pressure, or a system that's putting pressure on states to open up their markets and reduce trade barriers. You need some way of maintaining the security of trade lanes, because if you can't move goods across the ocean, if you can't move goods safely and securely, if piracy is a problem, then you're not going to see global trade happening. And so in the 19th century, it was the British Navy that patrolled global sea lanes and made sure that piracy was more or less beaten back. In the 20th century, it's largely been the U.S. Navy that's patrolled global sea lanes and dealt with piracy. And now we have other states, India and China and Japan, that are participating more actively in patrolling those sea lanes and making sure that piracy doesn't strangle global trade. You need some mechanism to provide liquidity through lending. I used to say that, oh, don't worry about this one. This is something that only happens in really extreme cases. Well, we just went through one of these times where this mattered a lot. In 2008, we saw the collapse of the global financial system with the subprime mortgage debacle. And what ended up happening was that banks freaked out and they didn't know which banks were solvent and which banks were not solvent. And so banks would not lend money to other banks, which is the liquidity piece, the money moving through the system fluidly, so it can go from those who have money on hand to those who need money in order to make loans or pay debts or do business. And if you have that fear paralyzing the system, then money doesn't move, and essentially the whole system locks down. And banks that normally could, fill up your checking account with cash when you pay your workers, suddenly can't fill your checking account with cash, and it risks destabilizing the whole system. And so the way you deal with that is you calm the markets, you reassure banks that there's money available, and that might mean assuming the debts of banks. It might mean providing them access to loans. It might mean flooding the global economy with cash, trying to get money flowing again. And so extreme measures in times of crisis are needed to keep that system from fraying and falling apart. We'll talk more about that when we talk about the Eurozone crisis, where we see some of this dynamic playing out. You need some mechanism for dealing with exchange rates, that if exchange rates are swinging wildly out of hand, it's really hard to do business across currencies, and so you need some mechanism to stabilize and make predictable exchange rates. And then lastly, you need some way to coordinate macroeconomic policy. That's the policies related to dealing with recessions and preventing economies from overheating. And typically what you want is when the global economy slips into recession, you want all countries to sort of push in the same direction to try to get the global economy restarted. And so again, with that 2008 economic calamity, we saw meetings where states came together and all sort of said, yes, this is what we're going to do, and this is how we're going to respond, and this is what we're going to do to try to restart the global economy. Now, the thinking is that all this stuff is incredibly expensive, and so to give you sort of a sense, the TARP program that bailed out the banks in 2008, that was put in place to provide liquidity in the system, was roughly $800 billion. Coordinating macroeconomic policy was about $800 billion for the United States to launch its stimulus program. The U.S. has spent hundreds of billions of dollars in stabilizing exchange rates and buying up bonds and assets of other countries, trying to keep those things in balance. And so there's a large cost that's involved in trying to maintain the infrastructure of a global economy. And the thinking is you need a large, powerful, wealthy country to make this happen. The reason why we think that is that during the 1800s, we had a global economy, and Great Britain was providing a lot of that infrastructure. It was providing the liquidity in lending because London was the heart of global banking and the global investment. It was patrolling sea lanes. It was such a major player in investment that it could deal with recession largely and enforce sort of a gold standard system for currency. But after World War I, Great Britain was greatly weakened. The center of global finance and investment shifted from London to New York. The British Navy was on the wane, and the Great Depression stepped in, and trade barriers went up, and Great Britain was essentially helpless in the face of the splintering of the global economy. And then after World War II, we saw global trade reemerge. And so an interesting little detail I like to throw out is that when we look at the volume of global trade in 1913, before World War I disintegrated the global trading system, we had a very high level of global trade. We didn't reach that level again until 1990. So the world was very globalized prior to World War I, and after World War II, we were able to rebuild that globalized system, and it was able to be rebuilt because we had a new hegemon. We had the United States that was 50% of the global economy, that put in place these institutions like the GATT system, later the World Trade Organization system, and took up a lot of the burden of managing the global economy. So the mechanism that the United States used to help revitalize or revive the global economy was what we call the Bretton Woods system. And it's named that because in the wake of World War II, the Allied powers came together in Bretton Woods, New Hampshire at a resort hotel. They got together and they hammered out the framework that would govern post-war economic cooperation. And there were a couple organizations and institutions that were created out of this Bretton Woods meeting, where the United States provided a lot of the cash and the leadership to kind of get the system going. The three institutions were the World Bank, which has a longer title of the World Bank for Reconstruction and Development, which was fixing the stuff that was destroyed by World War II. It was a development bank. Secondly, there's the International Monetary Fund, which was created to deal with currency and exchange rate issues. And then lastly, the Allied powers, led by the United States, created the General Agreement on Tariffs and Trade, the GATT system. And again, these are intended to provide the infrastructure for the global economy. The World Bank to help with macroeconomic policy and development, the International Monetary Fund with currency stability, and the General Agreement on Tariffs and Trade with getting trade barriers down and promoting an open system. So let's talk about the World Bank system for a little bit. It's actually the World Bank Group, because over the years, that initial World Bank, the International Bank for Reconstruction and Development that was created at Bretton Woods, has expanded, and they've sort of added on additional institutions. And it's sort of an interesting story, sort of how the World Bank has evolved over the years. So initially it was the International Bank for Reconstruction and Development. The thinking was you rebuild Europe, maybe you help out poor countries, less developed countries, by giving them money and loans to build projects, to build infrastructure. And the record for Europe for this was very good. The Marshall Plan, the billions of dollars provided by the United States to rebuild Europe, helped revive the global economy and helped revive Europe and then Japan later as well, in a matter of a couple decades, so that we had this incredible sort of resurrection of the destroyed economies of Europe. However, we didn't see the same kind of economic success for poor countries, for less developed countries, or LDCs. And so the World Bank began creating additional institutions to try to develop, to make the loans more effective. And so one of the thinking was, well, we're giving these loans to governments, but maybe we should be funneling more money to the private sector, to businesses, to industry. And so the International Finance Corporation was created to help companies and businesses in poor countries get access to capital, get access to cash, so that they could expand and grow. The International Development Association said, well, there are some specific problems facing poor countries in terms of disease, in terms of poor health care, or underdeveloped water and sanitation, and the International Development Association provides sort of humanitarian loans to build up humanitarian infrastructure, whether that's health and sanitation, whether that's education. These loans are interest-free. Most World Bank loans are a fairly low interest rate, but there is an interest rate in place. The International Development Association was trying to encourage states to take on these loans by giving them the lower interest rate, thinking that if you can build up the human capital, if you can get your human population to be healthier and better educated, that will have large development spillovers in addition to the humanitarian benefits. In the later 1960s, the World Bank took on the task of trying to facilitate international investment, and so they created the International Center for Settlement of Investment Disputes. Essentially, if you buy up a plot of land and build a factory on it in a developing country, and the government seizes that factory in a nationalization program, where you get the World Bank to step in and help mediate those disputes. If there are contract disputes between a foreign subsidiary and a partner in another country, that can be worked out through the International Center for Investment Disputes. And then in the late 1980s, the Multilateral Investment Guarantee Agency was put in place, which essentially is a way of promoting investment in developing countries by providing essentially insurance for multinational corporations and for other investors that are investing in developing states. So if their investment is lost because of nationalization, government seizing the land, seizing the investment, the Multilateral Investment Guarantee Agency will help recoup the cost or the loss. And so essentially the World Bank went from providing loans to governments for rebuilding infrastructure to other types of loans, to essentially trying to facilitate foreign direct investment, investment by other entities, hedge funds, pension funds, stock market, and banking funds into developing countries. So I should also point out that with each of these new institutions, it wasn't as though the others went away. All 5 of these different institutions are working, and then they're all sort of working semi in tandem together under the heading of the World Bank Group. The International Monetary Fund does a little bit of a different job, and their names are a little bit confusing because the World Bank provides these pots of money to states for development. You might even call that a fund rather than a bank, whereas the International Monetary Fund, I think, actually functions more like what we would think of as a central bank for the world. But the International Monetary Fund is essentially a structure and institution created by powerful states, wealthy states, although all states more or less are members. And its purpose is to maintain fixed exchange rates, as were set up at the Bretton Woods meeting, where every country more or less says, this is what my exchange rate will be, and I'm going to hold to it. And if you run into sort of currency problems, the International Monetary Fund is there to sort of help with that. We'll talk more about the details of that when we talk about the currency system, but that system was in place from 1944 to 1971. It doesn't exist anymore. The International Monetary Fund is still around. Its new mission is sort of a mix of consulting. It will go in, it will look at the sort of financial situation of a state, it will look at the economic vitality of a state, and will make recommendations for how to improve your economy, or improve your currency situation, or strengthen your trade or export markets, whatever you're interested in. So they'll do the consulting piece. But they're also the lender of last resort when there's a crisis, when it looks like a banking system is collapsing, when it looks like a currency is in free fall, or a government can't borrow any longer. They'll oftentimes turn to the International Monetary Fund and say, help us, we can't get cash, we can't get loans from anybody else, will you help us? Because if you don't, we're going to face economic calamity. And the International Monetary Fund will then meet, and they'll discuss, and they'll decide what they're going to do, and they may help to stabilize that currency or salvage that financial institution, depending upon the politics involved. Oftentimes, when that happens, the International Monetary Fund will put riders or restrictions, or what they'll call them structural adjustment loans. When they give loans, they'll say, oh, you can get the money that you're asking for, but you need to address some of the fundamental problems behind the crisis. You need to change your economy. You need to cut down trade barriers. You need to reform your financial sector. You need to rewrite your contract law. And they'll have a list of different things that they want to see change in the economy in exchange for their loan, in exchange for the money and the support that they're providing. I could talk a little bit more about the International Monetary Fund and some of the concerns and frustrations of developing countries, but I do think that that's a much larger conversation. We'll get to it elsewhere. In terms of how this all fits into the idea of hegemonic stability, these are the institutions that were designed to sort of support the global system, and they were created largely by the United States for that global system. But since the 1970s, the United States has not been a hegemon. the economies of Europe, the economies of Japan revived, and the U.S. declined from 50% of the global economy to about 20% of the global economy. And yet, the global economy hasn't collapsed. And so when we look at that and say, well, why is that? We might want to revise the hegemonic stability thesis. It still might be the case that you need all this economic infrastructure in order for the global economy to work, but once that economic infrastructure is established, once states are participating in a global economy, once states are benefiting from a global economy, the powerful state may not be needed to keep it going as long as you get a group of states committed to keeping that system going that collectively can share the burden. Now, if the powerful state weakens, as the United States did at the end of the 1960s and into the early 1970s, or if it decides it's no longer willing to carry all the costs, the system can survive if other states step in. And so in the 1970s, the G7 was created, that group of 7 industrialized nations, the United States, Britain, France, Germany, Italy, Japan, and Canada, as a way of addressing the kind of economic problems and providing sort of the global economic stability that the United States had once provided by itself. And so the thinking is cooperation might be able to sustain the system if you can get that cooperation to work. That's the big question. Right. So in the 1970s, when the United States weakened, you get this cooperation to sustain the global system from the states that are members of the NATO alliance system and Japan, which is part of a bilateral security arrangement with the United States. Essentially, all the states were democracies. They were all closely knit in terms of trade and investment. They were all more or less on the same page in terms of the big questions of the global economy and of global politics in general. However, the global economy has undergone a pretty big shift. And in 2008, with the global economic crisis, the G7 plus Russia, this thing that existed for a short while called the G8, looked at the scope and the scale of the global economic crisis and realized it was beyond them. They just didn't have the resources to respond effectively. They weren't able to pull the global economy out of recession, forestalling a depression, and they simply couldn't stem the liquidity crisis that was tearing down and paralyzing the global financial institutions. And so the G20, which was this larger body of states, was really the primary tool that was used to manage that crisis in 2008. And the G20 is a much more diverse group of states. It includes Saudi Arabia and Turkey and Indonesia, it includes Brazil and India and Mexico. It includes South Korea, and it includes, I think Thailand's in there. There's a lot of different states that are at different levels of democratic development. China's in there, for example. You can't manage the global economy without China. It's the #2 economy in the world. So some of these states are authoritarian, some of these states are democratic, some of these states are rich, some of these states are poor, some of these states are there just because they have oil. Saudi Arabia. It's not they're particularly large or important, it's just they have oil. And they're not all part of the U.S. alliance system. In fact, some of the states within the G20 are U.S. adversaries. And so you're going to find, if this is the body that's needed to manage the global economy, that it's going to be much more difficult to get everybody on the same page and to achieve the kind of level of cooperation that was possible with the G7, just because the group of states you need to sort of maintain stability is a much more complex, diverse group of states.